JBlog 2010, August 8th. So, last weekend I did not record a blog because I was busy. I was actually photographing a Sikh wedding. It was a ton of fun. First one that I've attended. And I need a little bit of time off from finances and markets. So, that was a ton of fun. But now, here we are back again with another week of exciting fun for some. Obviously not us bears. Looking at this chart, here we're looking at the New York Composite Exchange. And obviously this last week was very strong on Monday. And then on Friday it was very weak. And then pulled up. If you look at this the Friday candlestick. Now when we look at that in detail, you'll see that the pull-up is actually not as strong as it looked if you just look at the final candle, because basically all of your action happens in the last hour, and that is once again Wall Street. Last hour on a Friday afternoon, market rally is, well, just have to call it BS, because realistically it's one of those things that, really don't make any sense whatsoever. There was no news. They just wanted to make a good print. They know that there is lots of technical traders out there. They also know that lots of them only look at the market once a week. And that's what they wanted to do, is a nice print for that week. Otherwise, this would be quite a dreadful week. If we look at the weekly chart, if that had not been for that Friday last hour, then that would be a topping candle and potentially lead us into some weakness. But obviously Wall Street is not interested in weakness, because they can't earn money on weakness. They only know one thing, which is to buy. If we look on an hourly, actually 5-minute basis for the entire week, we see the run on Monday, and this is basically what happened. The run on Monday all happened in the first hour on some good information that came out that really wasn't that good, but the market just wanted to run. It didn't do anything. It started growing very weak towards Thursday. Then on Friday it dropped in the morning. And then there's this final up. So this is basically a non-event, a non-week. We'll see what happens on Monday. If you look at the chart like this, it's a pretty weak chart. I really don't know exactly what to make of the market right now, to be honest. There's so many experts and nobody exactly knows what is going on. For me, I don't see anything has changed. I don't see things having improved. I see the US government and the world governments, for that matter, having pumped trillions of dollars essentially into banks. They have saved banks everywhere, and the consumer has been shafted. Obviously that money is borrowed. The US now has a $13 trillion debt, and that becomes a problem for future generations to pay that back, but even for the current generation to pay interest on that, because interest will appear on that. So every year interest will have to be paid, and that is money that needs to be taxed or borrowed, and that will not be reinvested into anything useful. It just disappears into the pockets of bondholders, be they in the United States or somewhere internationally. Obviously China will get a large chunk of that. Japan will get a large chunk of that. Everyone will get a large chunk of redirected taxpayers' money, which can no longer be invested to lead to prosperity where the money is earned. So obviously that is going to lead to problems. And even if we dig our way out of this current mess, the messes will be faster and they'll be bigger in the future, just because the whole thing is flawed. Everyone has too much debt. Nothing has changed. So from that point of view, I continue being as bearish as I possibly can, because I do not see that the fundamentals have actually changed. Here's a bunch of articles I came across. Wall Street Journal, the recovery loses momentum, blah blah blah. So we're seeing some clouds on the horizon, even in the major news sources that have always been very bullish. Here we have the PE ratio, the S&P 500 PE ratio, which is still running at 20. Anybody who says this market is undervalued is crazy. 20 is not undervalued. 8 or 6 here in 1920 or in 1930 or in 1982. We were down low. That was undervalued. 20 PE ratio of 20 means if you bought the entire company, the entire S&P 500, you'd have to wait 20.6 years to get your money back. You haven't made any money yet. You just gotten your money back, and then you own the company outright. That's not much of an investment. PE ratio of 4 to 6 is very good. 8 to 10 in growth companies, yes, maybe even 20, but the S&P is not growth. The United States in general is not growth. The entire Western world is not growth, because we're going into an age of retirement where sustaining current sizes will be challenging enough. There is no growth coming. On the other side, the dividend is pathetically small. Companies are paying 2% dividend. You might as well go into T-bills for that, or into short-term bonds. They'll definitely give you a better return. So from a PE ratio and from an S&P 500 dividend yield ratio, there is simply no value to be found there. So it comes down to what I refer to as the greater fool theory, which means that you buy something, you know you're a fool for buying it because it's overpriced, but you're hoping that you will find an even greater fool that will buy it from you at an even higher price. And that happens all the time, but that is not sustainable. Interesting news story that came out here. There is some rumor that Obama and his minions are thinking about bailing out all of those homeowners that have an upside down mortgage, which basically means that they owe more money on it than the house is worth. That's not great news. Actually, that's pathetic news. All they're looking for is they're trying to keep people to continue being indebted to a house that is way beyond what they can afford. They don't want them to walk away. Again, they're not saving house owners, they're simply saving banks. That is all they're doing. So they're giving another 800 billion to banks, yet more taxpayer money to keep people indebted. Here's an article I came across. Some of the hedge funds that made good money in 2008 and 2009 riding up this temporary up are turning rather gloomy. The growth rate in the US is slowing. The consumer spending is of course eroding because the consumer has been shafted at the expense of banks and very large companies, which of course have very large unions. We know what this government is after. So keeping the banks happy, keeping big business happy, keeping unions happy, that's where the money comes in. So that's what's going to be done. Here's a story that banks in Europe will have to refinance 122 billion in bonds this year. That's of course money that they borrowed to stay alive. That money will have to come from somewhere, and sooner or later musical chairs will happen, where somebody will run out of chairs simply because there's not enough money out there to buy all of those bonds. It will happen eventually. Consumer bankruptcies may exceed 1.6 million this year. Again, big time shafting for the consumer. One thing I've been working on is I've been working on a blog, an actual writing blog. So I've set up a blog. It's at amp.co, Oak blog. It's just something that allows me to write out my ideas. It's very primitive right now, nothing special about it, but whenever I find something I pop it on there. It's kind of the next step after the Twitter thingy that I do as well. So yeah, do check it out. Let me know what you think. As long as it's nice. Don't let me know what you think if it's not nice. I really don't want to know about it. And all the best next week. Good luck trading and make lots of money. Bye.